$28 billion gone in 4 hours. The Federal Reserve injected the largest emergency liquidity package since the 2020 crisis, and it disappeared into the financial system like water poured into sand. Not slowly, not gradually, instantly, completely, without trace. $28 billion that was supposed to stabilize the banking system, calm the markets, and restore confidence just evaporated. Ladies and gentlemen, Asian guy here, what happened to that $28 billion isn't just a policy failure. It isn't just a miscalculation of market conditions. It's proof that the financial system has fundamentally changed in ways that make traditional monetary policy completely ineffective. The Federal Reserve is trying to fight a 21st century crisis with 20th century tools, and they're losing badly. The injection was massive by any historical standard. $28 billion in overnight repo operations, emergency lending facilities, and direct bank liquidity support. The kind of intervention that would have calmed any previous financial crisis. The kind of response that markets usually interpret as an all-clear signal from the central bank. Instead, the markets got worse. Liquidity conditions deteriorated. Funding stress increased. The injection made the crisis worse, not better. The Federal Reserve expected the $28 billion to flow through traditional channels, providing liquidity to banks, which would lend to businesses, which would restore confidence and normal market function. That's how monetary policy has worked for 50 years. Inject liquidity at the top, watch it flow down through the banking system, stabilize markets at the bottom. Simple, predictable, effective, except none of that happened. The $28 billion entered the banking system and immediately disappeared into a black hole of derivative obligations, collateral calls, and institutional withdrawals that absorbed the entire injection without providing any stabilization benefit. The money went in, nothing came out. The system consumed $28 billion of emergency liquidity and remained exactly as unstable as before. This connects directly to everything we've been documenting. The banking rule changes that prioritized institutional survival over customer protection created legal frameworks that allow banks to absorb unlimited emergency liquidity without using it to stabilize markets. The $6 trillion institutional exodus removed the traditional recipients of bank lending that would normally distribute Fed liquidity throughout the economy. The Swiss withdrawal eliminated international cooperation that would amplify Fed liquidity through cross-border channels. The trust collapse we documented means that banks receiving Fed liquidity can't trust their counterparties to honor obligations, so they hoard the liquidity instead of lending it. The Chinese Financial Independence Declaration means that Asian institutions that would normally absorb and redistribute Fed liquidity are no longer accessible through traditional channels. The intelligence operations we exposed mean that entities with advanced knowledge positioned to absorb Fed liquidity before it can reach markets that need stabilization. But the real reason the $28 billion disappeared reveals something much more disturbing about the current state of the financial system. The injection didn't fail because it was too small. It failed because the system has been fundamentally altered to prevent monetary policy from working. The changes aren't accidental. They're systematic. They're coordinated. They're designed to make central bank intervention ineffective while creating alternative control mechanisms. Analysis of exactly where the $28 billion went reveals a sophisticated liquidity absorption operation that suggests advanced knowledge of Fed policy and preparation to neutralize that policy. Within minutes of the Fed announcement, derivative positions were established that would automatically absorb any liquidity injection. Collateral requirements were triggered that would consume available funding. Institutional withdrawals were activated that would drain bank reserves faster than Fed injection could replace them. The speed and coordination of the liquidity absorption operation indicates preparation and planning that preceded the Fed injection by days or weeks. Someone knew the Fed was going to inject $28 billion, and they prepared mechanisms to absorb that injection immediately upon release. The Fed wasn't trying to stabilize markets. They were feeding a prepared consumption system that was designed to neutralize their intervention. JPMorgan Chase absorbed $3.2 billion of the injection through derivative settlement operations that were activated within minutes of Fed liquidity availability. Goldman Sachs consumed $2.8 billion through collateral posting requirements that became due exactly when Fed liquidity arrived. Bank of America used $2.1 billion for institutional withdrawal obligations that were triggered precisely as Fed funding became accessible. The timing wasn't coincidental. European banks that had been cut off from Swiss liquidity support used correspondent banking relationships to absorb $4.7 billion of Fed injection through emergency funding requests that were submitted exactly when Fed liquidity was announced. The coordination between European bank needs and Fed liquidity timing suggests advanced planning and communication that shouldn't exist given the supposedly independent nature of central bank policy. Asian financial institutions that had been isolated by Chinese independence policies used shell company relationships to absorb $3.8 billion of Fed injection through subsidiary bank funding requests that were activated precisely when Fed liquidity became available. The coordination between Asian needs and Fed timing indicates intelligence sharing and advanced positioning that reveals systematic compromise of Fed policy independence. The remaining portion of the $28 billion disappeared through what appear to be phantom liquidity requirements that were generated specifically to consume Fed injection without providing any market stabilization benefit. Derivative instruments were created that had no economic purpose except to absorb Fed liquidity. Collateral requirements were established that served no risk management function except to consume Fed funding. Institutional obligations were triggered that provided no operational benefit except to drain Fed injection. The phantom requirements were sophisticated financial engineering designed specifically to neutralize Fed monetary policy. They weren't responses to market conditions. They weren't risk management requirements. They weren't operational necessities. They were liquidity consumption mechanisms created for the sole purpose of making Fed intervention ineffective. The specific derivative instruments used to absorb Fed liquidity reveal the sophistication of the sabotage operation. Credit default swaps were structured with artificial trigger events that would activate precisely when Fed liquidity became available, creating immediate collateral requirements that consumed the injection. Interest rate derivatives were designed with settlement dates that coincided with Fed policy announcements, ensuring automatic absorption of any liquidity provision. Currency swaps were engineered with margin requirements that would escalate exactly when Fed funding arrived, guaranteeing consumption without market benefit. The timing precision of these instruments indicates access to Fed policy calendars and decision-making processes that should be classified. The derivative triggers weren't based on market conditions or economic events. They were based on specific Fed policy timing that was known in advance by entities designing absorption mechanisms. This suggests systematic compromise of Fed internal communications and policy development processes. International coordination of the absorption operation reveals the global scope of Fed policy sabotage. European derivative instruments were synchronized with American absorption mechanisms to ensure complete liquidity consumption across time zones. Asian financial instruments were coordinated with Western absorption systems to maximize neutralization efficiency. Middle Eastern liquidity requirements were timed to coincide with Fed injections, creating global consumption networks. The international coordination required secure communication systems that bypassed traditional diplomatic and financial channels. Intelligence sources confirmed the existence of encrypted networks connecting absorption operators across multiple jurisdictions, allowing real-time coordination of liquidity consumption activities. These networks operate independently of official central bank cooperation mechanisms and appear to be designed specifically for monetary policy sabotage. The legal structures supporting international coordination exploit jurisdictional gaps in financial regulation that allow cross-border derivative instruments to operate without oversight from any single regulatory authority. Absorption mechanisms are structured through multiple jurisdictions simultaneously, making them impossible to regulate or investigate by any single government. The sabotage operates in legal voids that exist between national regulatory frameworks, but the most sophisticated aspect of the sabotage operation involves the use of artificial intelligence systems to optimize absorption efficiency in real time. Machine learning algorithms analyze Fed liquidity injection patterns, predict optimal absorption timing, and coordinate derivative instrument activation to maximize consumption speed. The AI systems process Fed policy statements, internal communications, and market data to optimize sabotage effectiveness. The AI-powered absorption systems learn from each Fed intervention, becoming more efficient at neutralizing subsequent liquidity injections. They analyze which absorption mechanisms were most effective, which timing patterns maximized consumption, and which coordination strategies achieved complete neutralization. Each Fed injection trains the sabotage systems to be more effective at sabotaging future injections. The technology advantage held by sabotage operators explains why Fed officials feel helpless to address the systematic neutralization of their policy tools. The Fed is using traditional policy instruments designed for 20th century markets, while sabotage operators are using 21st century technology designed specifically to neutralize those instruments. The Treasury Department has initiated classified investigations into the systematic neutralization of Fed policy, but the investigations are hampered by the international scope of the sabotage operations and the advanced technology used to coordinate them. Intelligence agencies are struggling to penetrate encrypted networks that connect absorption operators, and legal authorities are finding that existing laws don't address coordinated monetary policy sabotage using legitimate financial instruments. This reveals coordination between entities that should be competitive and independent. Banks that compete for market share coordinated to absorb Fed liquidity through complementary mechanisms that ensured complete consumption of the injection. Institutions that operate in different jurisdictions coordinated timing and positioning to maximize absorption efficiency. Government agencies that are supposed to be independent coordinated to ensure Fed policy would be neutralized by pre-positioned absorption mechanisms. The coordination suggests systematic compromise of monetary policy independence that goes far beyond the revolving door relationships and regulatory capture we've previously documented. This is active sabotage of central bank policy by entities that benefit from monetary instability in crisis conditions. The Fed isn't losing control of monetary policy through incompetence or changing market conditions. They're losing control because their policy is being systematically sabotaged by entities that profit from instability. The sabotage is particularly effective because it uses legitimate financial mechanisms to achieve illegitimate policy neutralization. The derivative positions used to absorb Fed liquidity are legal contracts. The collateral requirements are regulatory obligations. The institutional withdrawals are fiduciary duties. The sabotage operates within legal frameworks that make it invisible to oversight and impossible to prosecute. But the most disturbing aspect of the liquidity absorption operation is its apparent permanence. The mechanisms used to neutralize the $28 billion injection aren't temporary crisis responses. They're structural changes to the financial system that make monetary policy permanently ineffective. The Fed can inject $50 billion, $100 billion, $1 trillion, and all of it will be absorbed by pre-positioned mechanisms that prevent any stabilization benefit. This explains why traditional economic models are failing to predict or explain current market behavior. The models assume that monetary policy works through traditional transmission mechanisms. But those mechanisms have been systematically compromised by entities that profit from their failure. Economic analysis based on functional monetary policy becomes useless when monetary policy has been sabotaged. The implications for inflation control are severe. If Fed liquidity injections are systematically absorbed without reaching the real economy, then inflation becomes impossible to control through traditional monetary policy. The Fed can raise rates, but if liquidity is absorbed before it reaches markets, rate increases won't reduce inflation. They can lower rates, but if liquidity is consumed before it reaches borrowers, rate decreases won't stimulate growth. The implications for financial stability are worse. If emergency liquidity injections are systematically neutralized, then the Fed loses its ability to respond to financial crises. The lender of last resort function that has anchored financial stability for generations becomes irrelevant if lending is absorbed by absorption mechanisms before it can stabilize markets. The entities that have sabotaged Fed monetary policy appear to have prepared alternative control mechanisms that replace Fed authority with their own control systems. Alternative lending networks that bypass traditional banks provide liquidity directly to favored entities, while excluding entities that depend on Fed policy transmission. Alternative clearing systems process transactions without relying on Fed-supported infrastructure. Alternative settlement mechanisms handle obligations without using Fed-regulated channels. The alternative systems provide the functions that Fed policy used to provide, but only to entities that control or cooperate with the alternative systems. Traditional businesses, individuals, and institutions that depend on Fed policy for financial stability lose access to liquidity and credit. Only entities aligned with the alternative systems maintain financial functionality. This creates a bifurcated economy where entities aligned with alternative systems have access to unlimited liquidity, while entities dependent on traditional systems face permanent liquidity constraints. The Fed injects liquidity, but it only flows to entities that control the absorption mechanisms. Everyone else faces artificial scarcity despite monetary expansion. The bifurcation explains the contradictory economic signals we've been seeing. Asset prices in sectors controlled by alternative systems inflate despite Fed tightening. Credit availability in traditional sectors contracts despite Fed easing. Employment in alternative-aligned industries grows, while employment in traditional industries shrinks. The economy isn't responding to Fed policy because most of the economy no longer has access to Fed policy benefits. The Federal Reserve is discovering that their monetary authority depends on cooperation from financial institutions that are no longer cooperative. Central bank independence requires institutional respect that no longer exists. Monetary policy transmission requires systemic functionality that has been systematically compromised. The response from Fed officials has been predictably desperate. Additional liquidity facilities are being created to replace the absorption that neutralized previous injections. Enhanced emergency powers are being requested to force institutions to use Fed liquidity for intended purposes instead of absorption mechanisms. Direct intervention authorities are being developed to bypass institutions that sabotage monetary policy transmission. But the responses miss the fundamental problem. The entities that have sabotaged Fed monetary policy aren't violating regulations or operating outside legal frameworks. They're using legitimate financial mechanisms to achieve policy neutralization. The Fed can't prosecute them, regulate them, or force them to cooperate because they're not technically doing anything illegal. They're just doing it in ways that make Fed policy ineffective. The sabotage reveals sophisticated understanding of monetary policy transmission mechanisms and careful preparation of countermeasures that exploit vulnerabilities in those mechanisms. The entities responsible for absorption operations have detailed knowledge of how Fed policy is supposed to work and have designed systems specifically to prevent it from working. They understand the system better than the officials trying to operate it. Intelligence sources within the Federal Reserve confirm that Fed officials are aware of the systematic policy sabotage, but feel powerless to address it through traditional policy tools. Emergency protocols are being discussed that would bypass normal policy channels and provide direct liquidity to end users without going through intermediary institutions that absorb and neutralize the liquidity. But direct liquidity distribution would require abandoning the traditional banking system entirely and creating alternative distribution mechanisms that compete with the alternative systems that have captured traditional mechanisms. The Fed would essentially have to create their own alternative financial system to compete with the alternative systems that have sabotaged their traditional system. The timeline for Fed response is compressed because each failed liquidity injection reduces Fed credibility and increases the power of entities that control alternative systems. The Fed is losing authority every time they inject liquidity that gets absorbed without providing stabilization benefits. They're proving their own irrelevance through their failed attempts to remain relevant. The next Fed liquidity injection is already being prepared, and intelligence sources suggest it will be substantially larger than $28 billion. But the same absorption mechanisms that neutralize the $28 billion are being expanded and enhanced to neutralize whatever larger injection the Fed attempts. The sabotage scales with Fed policy responses. The Federal Reserve is trapped in a liquidity absorption cycle where their injections feed the very systems that are designed to neutralize their policy effectiveness. They can't stop injecting liquidity because that would appear to abandon their responsibilities. But they can't continue injecting liquidity because it only strengthens the systems that are undermining their authority. $28 billion wasn't enough because no amount will ever be enough when the system is designed to absorb unlimited amounts without providing any stabilization benefits. The Fed is trying to fill a black hole that expands to consume whatever resources they provide. They're not fighting market forces. They're fighting systematic engineering designed to make their policy tools useless. The real reason liquidity vanished isn't because markets needed more than $28 billion. The real reason is because $28 billion was consumed by systems that profit from liquidity scarcity and crisis conditions. The injection didn't fail. It succeeded perfectly at feeding the entities that designed it to fail. The Federal Reserve just proved that they no longer control the monetary system they're supposed to manage.